The stock market is highly reliant on historically low interest rates. If rates rise higher, the stock market will be unable to continue this facade of a strong and robust environment. Of course, despite what the uneducated speculators believe, interest rates could not remain low forever. In order to maintain unrealistically low levels, the Fed must print money in what is known as open market operations. They're backed into a corner and will not save the stock market. You came here for the truth, so let me unveil that for you. Today we are going to look into the stock market, particularly in the US. I want to focus on the FANG stocks. We're going to look at interest rates. I want to show you what's going on in the actual economy itself, so gather around with your 7 shares of Amazon. And let's begin by taking a look at this article out of CNBC. Netflix has fallen more than 15% from its recent high. So this article gets into the more details of that all, but I basically just wanted to focus on the fact that this is a stock that has come up considerably since 2009, in particular throughout 2017, and even after the dip experienced in early 2018, it's really performed very well. But here in the shorter term, it's come down 15%. If it continues another 5%, we enter a bear market territory. It's not the only stock to do that, of course, but here it is. Now, this is one of those FANG stocks. This is a very popular stock. The company gets a lot of interest shown towards it. It's burning through a lot of money. There are a lot of factors here at play, but ultimately we can see that there has been this case of a lot of hot money flowing into fewer and fewer stocks. Netflix has really been benefiting from this, and so we've seen that happen over the last while, and we're just going to follow it and see what happens. Moving on, AMD. For those who don't know who AMD is, their main competitor is Intel, so you may have heard of that company. Their hot streak hit a brick wall this week. Its shares were on track for a weekly decline of more than 10% on Friday. They're worse than a year and on course to fall into a bear market after having dropped nearly 20%. Look at this. From its 52-week high, it's about to drop into a bear market territory. Looking at that, it is significant because this is one of those tech stocks that are very important. A lot of people are watching it. It's not part of the FANG group, but it is part of the tech shares, and tech stocks are clearly leading the charge here in the US markets, and you have consumer discretionary like Amazon and so on. But you're looking at this and have to realize how important all of these tech stocks are, because there's fewer and fewer stocks that are doing well today. And AMD not looking so good in the last 52 weeks that we can see over this period of time where they had come from. Obviously performing very well since 2009, but that 52-week high here, we're down about 20% from it. So I have to really start to keep a very close eye on it and understand that, you can't just have 5 or 10 stocks really pulling the entire market. It's not going to work like that. And then at the bottom paragraph here, I thought it was interesting, wanted to show you that this one individual said that he loves the 50-day moving average of this stock. It looks so great. It's wonderful. And these traders, these analysts, these algorithms are always looking at these technical indicators such as the 50-day moving average, the 200-day moving average, to be able to determine whether a stock is well priced or not. But when I look at this, I have to think to myself, these things are not real. They're not like this U3 garbage statistic. We're not looking at the garbage jobs reports that come out all the time. We're not looking at all these fake indicators. We're trying to look at the real economy, okay? So this here brings me to my next point. Technology stocks took another leg down on Friday, dragging the tech-heavy NASDAQ composite to its worst week since early spring. So this really brings me into what I want to get into, and that is here. Investors sold many of the year's best performing stocks, moving into so-called safety stocks such as utilities. So you can see that the investors, the institutional investors, have started to readjust portfolios, believing that maybe the top is in for tech as well. So let's get a little bit more secure and safe. Let's stop with the growth, and let's take a little bit off the top. We've made a lot of money all along this way, so let's take a little bit off the top and let's put it somewhere else. Okay, so that's what a lot of these investors are doing. I'm not talking about speculators, not talking about retail investors here, but we're talking about the institutions. The sentiment shift occurred as the stock market's momentum appeared to stall in the face of a sudden higher long-term government bond yields. Now, when I look at this, I have to think to myself, were they really surprised? We were told that the Federal Reserve is going to increase rates. They increase rates, and lo and behold, you have that affecting the bond market. And the bond market is massive. The bond market is gigantic. I'm going to show you a chart in just a moment here. Looking at this. Global bond market value in terms of US dollar, you can see what it has done recently. In fact, the weekly change is dropped to a level we haven't seen since 2016. So it is in this short period of time, it is quite significant, and that's shown on the graph up at the top here. Throughout 2018, you could see the money has been fleeing, but look, all throughout 2017, it had been increasing in terms of their total market value. This is a huge market by any stretch. Looking at this, it's bigger than the stock market. It's big. It's just huge. It's massive. So when you see money fleeing, it really, really is a lot of money. Okay, so I just want to get that into your head there. Let's move on to this. Market value impact of a 100 basis point rate shock. Interest rate sensitivity has increased to an all-time high. Now think about this. 1980 at the peak of the interest rates. Ever since then, they've been bringing them further and further and further down. During this period of time, you have these different recessions that have occurred. And in order to stimulate the economy, they bring interest rates down. And then when it starts to overheat, they bring interest rates up. They're always too slow, and they always don't do it enough. Okay, the only time they actually did it enough was in 1980. And ever since then, they've been having trouble getting interest rates to a higher level because every time they try, a recession hits. Okay, so that's what occurs. And right now, it's just even worse. Interest rate sensitivity has increased to an all-time high. And that's something that I just wanted to add to all the things that I've said before. Like if you look at the interest rates, right? So they peaked in 1980. Let's just say that's the peak there. And then ever since then, they have this problem. So they brought interest rates down. Then there's a period of time where they're, let's say, flat. Then they bring interest rates up. But then we hit a recession. Okay, so we got to bring interest rates down. And then it goes even lower. And then we try to bring them back up, but we can't get back to where we were before. And then it just goes like this, right? So we're constantly never able to get back to where we were before. And this is part of the issue. Interest rate sensitivity right now is the worst it's ever been. A little bit of an increase makes such a dramatic impact. And that isn't a good thing because interest rates are so low. Where do you have the room in order to play around with interest rates? And you don't. That's why they're trying right now at this time to get interest rates up so that they can kind of, when the time comes, they're going to need to bring that down. And if they're only at, let's say, 3%, that's not much room. They'll have to go into the negative territory. They did so, the shadow Fed funds rate, but I'm talking about the real Fed funds rate, and that's not good. This then connects in with my next point. U.S. mortgage rates for 30-year loans have quickly overrun the 5% mark in the last 3 days, planting a flag on territory they haven't touched since before the 2008 financial crisis. Huge, huge news. You know what? We were looking at this. Freddie Mac, 4.72%, if I'm not mistaken, on their mortgage rates. Now that's one thing. Then you look at the different banks and what they actually will give you a rate on. It doesn't matter what the government says, doesn't matter necessarily what the Fed funds rate is. It matters what the commercial banks are going to give you money at. And right now, this happens to be making reference to Cherry Creek Mortgage. That's Colorado's largest mortgage lender. Generally, we are seeing mortgage rates above 5%. So that is starting to get into very frightening territory for the entire market. Because as I've shown you before, and I believe it says it in this article when you go further down, it talks about how a small amount of money has a great impact on the average individual. And that was something like, this amount of money or interest is going to have an impact of about $100 a month for a lot of people. So $100 a month, for many people, they'd say, well, I'll make it. No big deal. It's not that big of an issue. However, this is a big issue for the studies that they've done showing many people at $200 an increase in expenses per month will bury them. And that is very worrisome, because if we're already at $100 now, it won't take much longer to get to that $200 mark. And then we start to have a lot of bankruptcies. We start to have a lot of foreclosures. We start to have a lot of people walking away from their debt. They're delinquent on their debt, and so on. Rates for a conforming 30-year mortgage before noon Friday were at 5.25%. So right there, that to me, it's significant. It's showing us what has happened to a lot of people and their affordability. But we're going to see that's just one market. We're going to see if it extends out into the rest of the US and if it persists. I do believe it will persist. Maybe it'll take a few months for many markets to pick up on that, but I think it will. Now, this here is another article out of the Denver Post, and basically it's just talking about the median price of a single-family home in September dropped 3.8%. Okay, that's still up from where it was previous. Let's not twist the words here, but certainly it is dropping. And when you look at the luxury market, which is anything worth over 1 million or more, those sales 44% down in 1 month. Significant drop, because they're looking at it all of a sudden, they're seeing interest rates go up and they're thinking, okay, I'm just staying put. I'm not moving. Let me just hope that the market will get better. That's what a lot of people are doing right now. And there's this hoping and praying based on everything that we're seeing in the economy. I think it's a big mistake for people to do that. That extends into the wider economy itself. Now, looking at this, retailers are anticipating a strong holiday season boosted by a healthy economy and burgeoning consumer confidence, but an intensifying slump among shopping mall operators shows not all are benefiting from the recovery. Mall vacancy rates rose to 9% in the third quarter, the highest level in 7 years. So we've got a problem with these shopping centers, of course. We've talked about this many times before. Macy's, JCPenney, Sears, Kmart, they're all suffering. They're all shutting down. They're going out of business. These companies are laying off people. The anchor stores are closing, and so on. We've talked about that. E-commerce is rising. We've talked about that, okay? So that's something that I've just covered so many times. I'm not going to waste your time on it. But this here was initially brought to me by a subscriber. I looked into it, found this. Calgary's eerily empty New Horizon Mall postpones grand opening. If you watch this is pretty amazing. There's this massive mall. I think it's going to have like 500 stores in it, but they're like small stores. And the different concept whereby basically an investor can come in, they buy the store like as if it's a condo. So they buy it, then they can rent it out to a business owner, or a business owner can buy it themselves. But generally the way it works is somebody buys it as an investor and leases it out. Unfortunate part is there's, out of these like 500, there's only like 9 actual businesses operating in it. That is truly worrisome. This is in Calgary. So we're looking at Canada being affected by this as well. There's too much retail. Why would somebody want to do this? Why would somebody want to open a store in this place to have, 38 jewelry stores, 14 hair salons? I mean, does a mall really need to exist like this? Maybe this is becoming the new way, and that is going to a different type of business. There's the high-end luxury retailers that I think will still do well. You have these people that will come in, they want to go to a boutique location, they want to receive grade A service, the valet parking and all that. And then you have like the online retailers, or you have like the Walmarts and things, which do a lot of things online today, the one-stop shops and things. So I think a lot of things are changing today, and that will have a dramatic impact on business, on the economy, and new jobs and everything. So keep your eyes on this. I'm going to keep you posted on the details of all of this. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel. So I do appreciate that very much. And if you want the financial education you were not taught in schools, these 2 books have it all. You can get this at Amazon. Link is in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.